This is part 2 of section 5 of Personal Finance Minnesota Virtual Academy. In lesson 3, types of credits you'll learn about, features of credit, credit card advantages, disadvantages, lines of credits, and loans and applying for loans. Your credit limit is the maximum amount a lender will give you. In some types of credit, such as credit cards, you'll get to decide how much credit to use as long as you stay under the limit. You might not be allowed to go over your credit limit, or you may be charged a fee if you do. Many lenders, including credit card companies, offer you credit with an interest rate measured as an annual percentage rate, APR. An annual percentage rate is an annual interest rate that doesn't take into account any compounding of interest that happens during the year. An annual percentage yield is an annual interest rate that does not take into account compounding that happens during the year. APY is more accurate because the amount you really pay in interest, because compounding of interest often happens monthly, which means that interest gets added to the principal monthly and starts earning its own interest. Interest rates can be fixed or variable. A fixed interest rate is set at a specific percentage and will not change. A variable interest rate can be changed. It's usually set up to move up or down when interest rates in a larger economy move up and down. A variable interest rate is also called an adjustable rate. Some lenders may offer good interest rate at first and then raise it after 6 months or a year. Some credit card companies may offer 0% at first, then raise it to something much higher than after 6 months. Fees are specific charges that a borrower must pay a lender in exchange for a specific service. This is different from interest. A credit company might charge you a fee for making a late payment, for using your credit card to get cash from an ATM, or for using your card in a foreign country. A grace period is the amount of time you have to make a credit card payment before a late fee is added to the balance. Your APR may increase if you make late payments. Annual percentage rate may increase. So which type of interest rate gives you the most accurate measure of the amount a borrower will really pay in interest, because it takes into account compounding that happens during the year? Annual percentage rate, annual percentage yield. Annual percentage yield is the most accurate measure of the amount a borrower will really pay in interest, because it takes into account compounding that happens during the year. As you know, there are some advantages to a credit card. You can benefit from this best by using credit wisely and not allowing debt to remain on your credit card for too long. As you know, having a credit card responsibly and using it responsibly allows you to build a good credit score. Credit cards are protected against loss or theft. If your credit card is stolen and someone uses it, you won't be responsible for those charges. If your debit card is lost or stolen and someone misuses it, they may take some or all of the money out of your bank account. So most banks will reverse those charges like credit card companies, but that money will be missing from your bank account while you wait for the reverse charge. There are also incentives for advantage of a credit card. Some credit cards offer incentive programs that give you rewards for making purchases with a card. A credit card might offer a mile of airline travel for each dollar you spend, or a small percentage of cash back on all credit purchases you make at the end of the year. Another advantage is that credit cards provide you with a statement of your spending. This way you're easily able to see where you're spending money and determine what the areas you can cut back. There are some disadvantages to using a credit card, and the main challenge with credit cards is that they require you to be disciplined about your spending, and for many people it's tempting to use credit to buy things they can't afford. This temptation doesn't happen when you're using cash, because you have to stop spending when your cash runs out. Another disadvantage of credit cards is interest rates on credit cards are often very high. It's not unusual for them to be 10% to 20% per year. That's much higher than you're likely to earn on most investments. So another disadvantage of credit cards is that it can be a challenge to understand all the details about how your credit account will work. It's your responsibility to pay attention to any notices the credit card company gives you regarding changes in the policy or in the way your account is set up. Some credit cards company make it difficult to understand all these fees associated with your account. So which of these is an advantage of using a credit card? Oops. Credit card accounts are always easy to understand. Credit cards have low interest rates. Credit card accounts can be used as a savings account, or the last one, which is true, credit cards are protected from loss or theft. So you have a sense of security. If someone takes your card and uses it without your permission, you're not responsible for that debt. Lines of credit is a type of short-term credit a lender can offer that includes a maximum amount of credit and a maximum length of time, but lets the borrower decide how much credit to use. Interest is only charged on the amount of credit the borrower actually uses. In this way it works as kind of a credit card, but a line of credit is usually money given by the lender to the borrower instead of a credit that is used to pay for purchases. A loan is money that you borrow from a person or organization with the commitment to pay back the amount in full, usually with a specific time limit, number of payments, and interest rate agreed upon in advance. Loans are usually made for a specific purchase or purpose, such as a car loan, a business loan, a home loan, and a home loan is usually called a mortgage. The amount of money the lender gives the borrower is called the principal, and the main amount owed. If you borrow $200 from a friend, the principal is $200. How a loan works. If you're making monthly payments on a loan, the interest and principal are usually recalculated monthly. Your earliest payments will have a large amount of interest, and over time that shifts so less goes toward interest and more goes toward principal. You get a car loan for $20,000 with the payments of $300 per month and an interest rate of 10%. In the first month, the principal is $20,000. This means the interest is $2,000 per year because 20,000 times 0.10 or 10% equals 2,000. To get monthly payment, divide 2,000 by 12, and since you're already paying 1 month's worth of interest at a time, your payment is $166.67 due in the first month. So if you borrow $5,000 to remodel a home at 5% interest, so the principal is a 5% interest, what is the principal? Is it the $5,000 or the $5,250? No, it's actually your principal is the amount, is that which the lender this is the amount you received from the lender, $5,000. Your interest is $250 per year. There are loan factors. Your credit history and credit score are important factors that lender will consider. If you don't have a credit history or score, it will be difficult for you to find a lender. A good credit score will help you get a lower interest rate. Collateral. Collateral is an asset or a group of assets that are linked to a loan. For a car loan, the car is collateral. For a home loan, the home is collateral. For a small business loan, the collateral might be equipment and supplies used for the business. There are also other loan factors like income. If the loan is a personal loan such as cars or a home loan, the lender will want information about your income and other financial obligations to show that you can afford the monthly payments. Lenders will want to see that you have enough cash available at all times to pay your bills. It will also be helpful if you can show your financial commitment toward the purpose of a loan. In the case of a home or car, this takes the form of a down payment. A down payment is cash payment made by the borrower of a percentage of the total cost of the asset. Home and car loans usually require a down payment. Loans that are more long-term usually have higher interest rates than short-term loans because the lender's money is tied up for a longer and long-term future is less predictable than the near future. And one other loan factor is interest rates, which are also affected by the national and global economy. They rise and fall based on complex economic factors. So an asset that a lender can collect if a borrower fails to pay is called collateral, finance charge, payment, or principal. Well, I think it's collateral. In lesson 3, we talked about the features of credit, credit card advantages and disadvantages, lines of credits, and loans and applying for loans. Here's an example of a financial profile. We have Miranda Marti. She is a physician and acupuncturist. Some of her biggest expenses are rent, food, student loan, and travel. She keeps track of her spending and financial activity. She relies on her online bank statements to keep track and month-to-month spending. To give an example of financial goals she's met, well, a financial goal I met is starting to repay my student loans. And what are some of her current financial goals? My current financial goal is to put up to 10 to 20% of my paycheck into savings. Has anything surprised you about managing your own finances? Well, she was surprised to find that she has a natural inclination to live within her means. I'm also surprised to find that some items are inflexible. For example, I can cut back on the number of times I go out to eat, or I can eat less expensive meals, but I won't eliminate going out to eat entirely from my budget because that's time I spend with friends. Do you think educational background has an impact on your finances? Yes, I came from a very hard working class background where I was brought up to pay for things up front and not spend money that more money than you have. And what advice does she have for someone who is learning about managing finances? Job shadow people in the fields you want to join. Ask them how to get how they got to be there and how easy it might be for someone to join the field now. And so also important thing about student loans or making big investments for anything, talk to a financial advisor, another third party about what repayment will look like for you in practical terms. So in this section, you learned about credit and debt interest, credit history and credit scores, types of credits, establishing credit, debt and bankruptcy, credit features, and applying for loans.